we know a lot about what's happened to asset prices in the past. We know the returns you get on equities in different markets. We know the returns from property. We know the returns from fixed interest securities and so on. And we've got a run that goes back over 100 years. One of the runs, it goes back, the old BZW one, Barclays one goes back, I think, 150 years. So we know a lot about what happens to asset prices. And we know that through world wars, through the depression of the 30s, through the great inflation of the 70s, through the zero interest rate stuff that we've had. We know a lot about it. And we know that if you save, the magic of compound interest will, over a 40-year period or a 50-year period, mean that you get a positive return on those savings in real terms. And you can then say, okay, how do you slice it? And I don't know what your view is, but my view is that you don't put all your eggs in one basket. The best marker, the most positive thing is global equities.
Yeah.
And
told you, mate.
Damo's doing a little internal dance now. He loves his.
Well, just because the S&P's been so dominant, right? But it's eggs in a basket, and there's no guarantee.
And then you could have a debate. Are you half in global equities? You've got to think of your own property. You're in the UK property market. You should own a home.
Exposure through owning a home.
You need something there. You may want some short-term fixed interest stuff because you're going to need the income and you may need the money in another year's time or something. But I think you're not. Don't be clever. And you probably want to play around a bit. And if you're brilliant at some kind of collecting, then sure, do that.
If you know Lego inside out, kind of thing.
Well, exactly. Or if you're into vintage cars,
But do you think the forces that have driven global equities up over the last 100 years will persist? Because one thing I see is there's a lot of discussion, Goldman Sachs recently, lower expected returns over the next decade, these kind of arguments. And I think people always worry oh God, okay. I'm too late. It's best is behind us.
So you go down from a 70 allocation to a 45 allocation, 45 of your allocation, maybe? What else do you do,
Yeah, I think this is a key point. What else? Where else are you going to put your money?
Where else are you putting it? Yeah, and I think that the key message, in the book, I worry about we will lose money, we will lose fiat money, and we will go to something else. Then,
you talked about broad exposure there a second ago.
You should have some gold, probably.
Yeah,
probably.
Okay,
not now, maybe, but you should have some gold.
You said global equities, property, gold. Why not a bit of Bitcoin then? Why not as part of your broad exposure?
5% of your money,
1%
in gold.
Would do it.
1% in crypto, or 5% in crypto. But don't be silly.
No.
Always be aware that
oh, look at me! I know what I'm doing.
75%. You know what you're doing when it's up. When it's down, you stay real quiet,
real humble.
But I think the big bet that I make is that the market economy will broadly continue for the next 25 years.
The world will keep turning.
The world will keep turning. There will be many opportunities in the emerging world because it becomes more important. But you shouldn't be silly about it because there are governance issues and there are all sorts of other issues there. But it keeps coming back to compound interest and being aware that inflation may be quite a bit higher over the next few years than the markets expect, which tilts one back towards property and equities. And if you can find a way into it, private equity too.
This is a clip from our chat with journalist Hamish McRae. To watch a full episode, click right here.
He's 81, mate.
Legend.
Yeah.
He's in better shape than you are.
Yeah, he really was. He really was.